Is inflation finally going to die? Listen, my friends, that's what it kind of looks like. Rates are dropping, prices are starting to cool off, and the Federal Reserve, they're showing signs that they might be starting to ease up. But what if I was the wet blanket and I told you that this could be the calm before the storm? But right now, even though it looks like things might be cooling off, we're seeing a pattern that's eerily similar to what happened in the 1940s and the 1970s. A temporary drop in inflation followed by an economic punch to the gut. So I want you to consider the biggest mistake you can make right now is assuming that the worst is behind us. So in this video, I'm going to show you why this drop of inflation might just be a mirage, how governments historically escape debt traps through stealth inflation, and what you need to do right now to protect and grow your wealth in all of the economic turmoil and chaos going around us every single day. Now, my friends, my name is Ryan D. Lee, and I'm the host of the Wealth Outside of Wall Street channel. And if you're tired of being lied to by politicians and financial pundits, you're in the right place. We uncover the real forces shaping your financial future, and we show you how to escape the trap and ultimately win the game of money without Wall Street. Our community, the ones who watch videos like this but actually take action using the passive income machine investment system, they achieve financial freedom in 10 years or less using cash flow, leverage, and a system to create wealth with all of the economic uncertainty around them. In fact, our community uses the economic uncertainty to their advantage to accelerate their path to financial freedom, like I said, in 10 years or less. So if you're new here, hit that subscribe button and buckle up, because today we're going to go deep. And here's what we're going to cover: why inflation is temporarily cooling and why it won't last, how Argentina is showing us a version of our very own future, what history teaches us about long-term debt cycles, and last but not least, most importantly, what you must know to profit from the chaos. Okay, so let's start off with a real-world example in Argentina with the new president, Javier Milei, who's taking a chainsaw to the government bloat, literally. He's cutting taxes, slashing spending, and firing bureaucrat after bureaucrat after bureaucrat, which is deregulating on a massive scale. And the results that he's getting aren't just minimal. Month-over-month inflation dropped from 25% to just 2.4% in just a few months. Economic growth is rebounding massively, and poverty and unemployment, they're actually falling for the first time in a long time in Argentina. Now, that's a radical turnaround, but it didn't happen without a lot of pain. And the people hurting the most are the government workers, those who are being paid through forced wealth transfers in the form of taxes. But everyone else is keeping, for the first time in a long time, more of their money, and that's leading to more prosperity. The question is this: are we seeing early signs of what might be coming to pass here in the United States? So in the United States, here's what we're seeing. Initial jobless claims for the federal workers have actually spiked. Housing markets in DC are starting to tank as government agencies and government buildings are being gutted and people are looking for new places to work and ultimately live. Over 10,000 homes are for sale right now in the capital region of Washington and DC at this very moment. And while deregulation hasn't hit hard yet legislatively, the executive branch is starting to pull back. Less government bloat means more room for private productivity. And according to the Constitution, you know, that thing that our country is based on, only Congress can pass laws. But for decades, the executive branch has piled on regulation after regulation, which is technically unconstitutional. And for the first time in a long time, all of that is starting to be challenged. Progress might be a little bit slow, but directionally, it matters a lot. We're getting back to the founding principles outlined in the Constitution of the United States. So now let's get to inflation and how all of this is impacting your wallet. So according to True.com, they're showing inflation dropping from around 3% to 1.7% in early 2025. If this is all true, this could give the Fed a little bit of leeway to start to ease up, to lower interest rates and allow money to flow a little bit more freely inside of the American economy. So much of what is going on right now is looking like it's heading in a positive direction. But my friends, tying back to the original opening of this video, we've seen this song and dance before, and if history repeats itself, then it's not actually going to last. From 1940 to 1980, we saw the US government deleverage from 120% debt to GDP all the way down to 30%. And they did this through inflation. The Fed, well, they pegged interest rates below the inflation rate. They borrowed at cheap levels, and they pushed the cost of the debt onto the people. Then from 1980 to 2020, we went through a leveraging phase. There were falling rates, falling inflation, and rising debt. Now we're back in the deleveraging phase once again. And if history is our guide, we'll see rising interest rates, persistent inflation, and wild market swings. Now, at the time of this recording, the beginning of April in 2025, the Dow and the world markets are going crazy, experiencing some of the largest drops in the last several years. And all of this is a result of Donald Trump's massive tariff war that is going on globally. Now, how this is going to shake out, this is anyone's guess, but this isn't a one-year cycle. This is a multi-decade shift. So knowing the big shift in the cycle that we're in, I want to give you a little bit of a playbook for your wealth. What this ultimately means is that your portfolio and your pathway to building wealth might need to be completely rethought. If we're heading into a market like we experienced from 1940 to 1980, not 1980 to 2020, here's what works. Active investing actually beats passive investing. And what I mean by this is it's going to be really hard for those who are blindly putting their money in the stock market in a well-diversified portfolio. You have to be way more attuned to the investments that will actually benefit from all of the chaos going around. Commodities and hard assets outperform tech stocks, value will likely beat growth, and real estate, gold, and other productive businesses are going to shine the biggest. So let me zoom in on one of the most powerful and consistent growth assets of all time, which is single-family real estate. Now, this is the most boring type of real estate, but that's the point. If you're watching this video right now, it's likely that you're already a hard worker, you're already pretty busy, and you don't need another job doing real estate actively. You don't want to be spending your nights and weekends trying to flip properties. But if you buy single-family real estate, you already have a level of inherent expertise. You know what a good neighborhood looks like. You know what a good home looks like. The most in-demand form of real estate is and always will be single-family homes. When a person wants to move out of an apartment complex or maybe even out of their parents' basement, they're looking for a single-family home. When a family wants to downgrade from the McMansion to a more affordable home, they're looking for a single-family home. But on the flip side of this high demand, there's been a massive underdeveloping of single-family homes for the last 20 years. And this disparity between supply and demand gives you a great opportunity to profit. But here's the benefit. You can actually do single-family homes relatively turnkey, meaning you can own the asset, but have many other people do the work of finding the property, rehabbing the property, renovating the property, even managing the property on your behalf. I personally have a portfolio of over 50 single-family homes that require minimal amounts of time, effort, and energy to manage a system, not do the work of operating the system. When I started my journey, I thought that cash flow was the key. And here's a couple of lessons that I'm sharing with my community of investors who've bought over 5,000 single-family homes collectively over the last decade. When I first started my journey into the game of real estate, I thought I needed to buy enough single-family homes or enough rental real estate that would give me a positive rental income so I could be financially free. Now, that's a very important thing to understand, is inside of the game of real estate, you actually profit in multiple different ways. I want you to consider this. When you own a simple single-family home, your dollar is actually working in 5 different ways within the same asset. Consider this. Number one, your asset is going up in value. It's appreciating. But at the same time that your asset is going up in value, you have a tenant in that home that's paying off your mortgage. So you are forcing equity into your property through appreciation and through amortization. That's 2 rates of return with one investment. On top of this, if you've done it right, your property should be generating for you a positive stream of income in the form of cash flow. If you've also bought the property using leverage, it means the bank has given you 80% of what you needed to buy the property, but you still control it. And I want you to consider this. One of the most powerful strategies with real estate is the tax code. The tax code allows you to keep most of, if not all of what you make in real estate, completely tax-free. This is the pathway to financial freedom. But here's the lesson I've learned over the last decade, and when you understand this, it will set you free. It's actually the equity inside of your real estate that will make you free. And if you know this, you don't need 50, 60, 70 houses all giving you a couple $100s a month of cash flow. You only need between 15 and 20 really good properties in really good areas. My first rental property produced a couple $100s a month of profit after all costs were accounted for. At that rate, I would need about 50 homes just to replace my income. And at that time, that was not even feasible for me to consider. And for most people, it's not scalable, nor is it realistic to consider having 40, 50, 60 rental properties. But when I step back, here's what I realized. Real estate appreciates because of 3 unstoppable forces: inflation, amortization, and supply and demand. I've already kind of mentioned each one of these to you, but in 1950, consider this. The median home value in America cost $7,000. Today, a median home costs $426,000. That's not a fluke. That's a trend fueled by fundamental economics. I mean, let me break this down for you by decade. I'm going to list it right here on the screen. But from 1950 to 1960s, the home values rose from $7,000 to $12,000. That's a 71% increase. From 1960 to 1970, values rose from 12,000 to 17,000. That's a 42% increase. From 1970 to 1980, 17,000 to 47,000. That's a 176% increase. From 1980 to 1990, the home values rose from 47,000 to 79,000. That's a 68% increase. From 1990 to the year 2000, home values went from 79,000 to 119,000. Again, a 51% increase. From 2000 to 2010, well, my friends, they kept doing the same thing. Home values rose from 119 to 222,000, an 87% increase. From 2010 to 2025, home values went from 220,000 up to 426. That's a 92% increase. So I want you to consider this. This isn't a fluke, it's a trend. Real estate has produced generational wealth for decades, not just because of cash flow, but because it grows in value almost automatically. Cash flow keeps you in the game to deal with all of the uncertainty of owning real estate, but equity is what actually makes you wealthy and free. But let me make this just a little bit better for you. While values rise, your tenants are paying off the mortgage. Every rent check grows your equity yet again. That equity is wealth that you can tap into oftentimes without triggering any taxes. In fact, at 99.9% of all banks in the country, you can take a property that is valued at whatever it's valued at, showing the debt that you have on it, and a bank will allow you to take 80% of the current value of the home out as a cash out refi. And let's be honest, everyone needs a place to live. Housing, it's not optional. It's a universal need. So it's an asset class that is always in demand. It's an asset class that is easy to manage. It's an asset class that is easy to outsource and just CEO the outcome of a system. And it's an asset class that can make you wildly wealthy with just a few simple assets inside of a system. That's why single-family homes, done right, are one of the few investments that across decades, cycles, and crashes consistently build wealth. But here's the reality. Real estate, it's not a get-rich-quick play, but it is a time-tested, nearly fail-proof engine for long-term wealth. So what should you do with all of this economic turmoil? I don't know. I know what I'm doing. I'm turning this type of knowledge into action. I'm buying up assets that have real demand and renting them out to people who are looking for a good place to live by building my wealth and allowing things like inflation to actually make me wealthier. So if this video opened your eyes, I want to invite you to do me a favor. Number one, share it with a friend. Friends don't let friends retire broke. Number two, drop me a comment on your biggest takeaway. And number three, don't forget to subscribe. Give me a comment, give me some insights. And if you want to learn more about how you can build a portfolio of cash flowing assets and ultimately become financially free in 10 years or less, just comment freedom down below. Until next time, I'm Ryan D. Lee. Stay bold, stay smart, and take control over your future. Fearless.